Every day, we trade, save, and stress over money. But who exactly determines how much of it exists and what it's actually worth? Before 1913, the United States financial system was highly rigid. The currency supply was tied directly to fixed assets like gold coins, silver, and government bonds. Because the volume of currency in circulation could not expand quickly to meet sudden public demand, local banking strains routinely cascaded into nationwide crises. A sudden rush for cash guaranteed devastating bank runs and deep economic depressions. Congress passed the Federal Reserve Act of 1913 to furnish an elastic currency. They created a central banking system designed to supply liquidity exactly when and where the market required it. Supplying cash on demand solves the problem of seasonal banking panics, but handing a central institution the ability to create money introduces a severe vulnerability: the temptation for the government to exploit the printing press to fund itself. During World War II, the United States needed to finance an enormous military mobilization. To manage the massive deficits, the Federal Reserve adopted a policy of fiscal dominance. The central bank actively suppressed long-term Treasury borrowing rates. They guaranteed affordable financing for the government, keeping yields low to encourage the public to buy victory bonds and subsidize the war effort. Holding interest rates artificially low while government spending surged caused immediate economic damage. Once wartime price controls were lifted, inflation spiked to nearly 20%. By 1951, the Federal Reserve and the Truman administration reached an agreement known as the Accord. This officially severed the central bank's obligation to peg interest rates to the Treasury's debt management needs. The 1951 Accord established a critical rule for modern finance. To effectively manage a nation's money, the central bank must operate completely independently from the short-term political pressures of the administration and the legislature. Today, the U.S. Treasury Department issues bonds and bills to fund government operations and manage the national debt. The Federal Reserve takes that issuance as a given and focuses entirely on the broader economy. Congress assigned the Federal Reserve a specific dual mandate: promote maximum employment while keeping prices stable. To achieve this, the Fed adjusts short-term interest rates. This chart shows how the Fed manages those rates in a modern system with ample banking reserves. By raising or lowering the interest on reserve balances, or IORB, the Fed creates a hard floor. Banks have no incentive to lend cash to private parties for less than they can earn risk-free directly from the central bank. To prevent rates from spiking upward, the Fed uses overnight reverse repo and standing repo operations. This acts as a ceiling, capping short-term borrowing costs and trapping the effective federal funds rate perfectly within the target range. The domestic money supply is not controlled by turning a single dial. It is corralled by specific financial boundaries, maintained through constant coordination between the Treasury's debt issuance and the Fed's open market operations. The mechanisms of control have evolved continuously. In the 1920s, officials realized that open market operations in one city instantly altered liquidity across the entire national banking system. Money flowed like water, requiring a unified national policy. By the late 1970s, facing double-digit inflation, Chairman Paul Volcker shifted the Federal Reserve to a strict operating procedure based on managing exact quantities of non-borrowed reserves and targeting specific monetary aggregates, known as M1 and M2. Financial deregulation and the invention of new banking products destabilized the relationship between those money targets and actual inflation. The models predicting money demand broke down entirely as banks created new types of accounts. This instability forced the Federal Reserve to abandon rigid formulas. Under leaders like Ben Bernanke, the central bank shifted toward complex forecasting models, expert judgment, and massive balance sheet expansions like quantitative easing. Managing the economy requires constant adaptation. Central banks are forced to continuously invent new operational frameworks to keep pace with rapid technological and financial innovations. Because between 1/2 and 2/3 of U.S. currency is held outside the country, domestic monetary policy creates international shockwaves. To monitor these massive international spillovers, institutions like the Bank for International Settlements operate in Switzerland.
Often called the central bank for central banks, it tracks the global financial system. This map shows how the BIS compiles locational banking statistics. It tracks the exact volume of US dollar-denominated loans and cross-border credit flowing between non-US nations. By deriving global liquidity indicators from this data, the BIS can monitor the buildup of vulnerabilities. They can detect dangerously fast credit growth in offshore markets before those imbalances trigger an international collapse. Effectively managing the world's primary reserve currency requires intensive international surveillance. No single central bank operates in a vacuum. Their policies echo across a highly interconnected global market. Global wealth is not determined by a single politician, a lone government agency, or a mastermind pulling levers in a hidden room. The true mechanism is a sprawling, interdependent network. It stretches from the auction rooms of the U.S. Treasury through the trading desks at the Federal Reserve Bank of New York to the massive data hubs in Switzerland. This decentralized web exists to walk a razor's edge, providing enough credit to fuel economic growth while actively containing the persistent threat of inflation. As borderless stablecoins, artificial intelligence, and digital ecosystems emerge, this network is rapidly rewiring itself for its next evolutionary test. The stability of the money in your pocket relies entirely on the continued independence, adaptability, and cooperation of this invisible global infrastructure.